The Fed is poised to cut interest rates for the first time in 4 years. Our next guest was on this show 5 months ago, and we asked her about her call from January about the size and pace of rate cuts this year.
100 basis points of cuts. We had them starting in July and going every meeting after that. And then we had a pretty dovish Fed to start this year, and we pulled that forward to June with 125, and that's been the call since early January.
Veronica Clark is an economist at Citi, and she's sticking with that call for the rate cuts totaling 125 basis points this year. That's 25 basis points today, then 50 basis points at the next two meetings, or 50 basis points today and in November, followed by a 25 basis point cut in December. No stranger to bold calls, she was one of the very early economists correctly predicting larger hikes in 2022. Veronica joins us right now. And Veronica, when you made that call back in April, we thought it sounded a little out there, but you seem to be more right than most people in the street.
we had a couple months where we sounded pretty crazy, but yeah, I think things have come around to our view, and that has been premised on the labor market weakening, which we're really seeing signs of in the data really at the end of last year, and that weakening has just accelerated, and I think the Fed has, of course, caught on to that and is increasingly worried about the employment side of their mandate.
There is a pretty large crowd on Wall Street who still say 50 basis points would not make sense at this point, that's too aggressive.
I think it would make a lot of sense. I think there's a lot of arguments for 50. We really don't know what is going to happen today. I think maybe 25 is where we can get the most agreement among Fed officials. 25, a dovish 25. They have to be sufficiently dovish here to not scare markets that they're maybe behind the curve, tighten financial conditions more. And I do think there are 50 basis points on the table for the next coming meetings, and maybe, of course, today.
Do you think they're behind the curve?
I think there is a good argument to make that if they had that July employment data that we got just a couple days after the July meeting, they could have cut at that July meeting. And so in that sense, you maybe are a bit behind the curve here. The weakening trend of the labor market has just continued this whole year. It might be a bit too late to prevent that at this point. And certainly you want to take rates closer to neutral, and you don't want to do that a year from now. You want to do that sooner.
I mean, the labor market's still in pretty incredible shape if you look historically. It's hard to argue anything with a four handle is out of control or hugely concerning. That's full employment by historical standards.
Right. The level of the unemployment rate is certainly not necessarily concerning. It's really the change that matters. And when you do see the unemployment rate rising this much, historically that does precede a recession. I think Fed officials are maybe complacent is not the right word, but feel okay about the labor market because you don't really see the big signs of layoffs yet, which is true. Although in the last couple months we have started to see those building. But if you're waiting to see widespread substantial layoffs, you're already too late at that point.
The only problem is you're still watching inflation, and they are not back to their 2% target. So this is not a single mandate by any stretch. They may be focusing a little more on the labor market these days, but the real mandate that if you look back at Fed officials from years back, Alan Greenspan in particular would say, I don't worry about the labor market. I worry about inflation, and the rest takes care of itself.
Right, and we certainly are coming from a higher inflation place than we've been in many years, many decades. And I think that's maybe why, after we saw the CPI print last week, that's really what led us to change our call from a 50 today to 25 today. The hawks might not be quite on board with 50 yet. Maybe 25 is where you can get the most compromise. But I think there are a lot of signs that inflation is finally slowing. The strength that we had in CPI last week was in the very lagged shelter component. And we do see housing weakness, new rents coming down. I think that will be slowing. And just generally a weakening labor market with wages also slowing. That is a good sign for target inflation.
We spoke with the CEO of KBW earlier this week, and his point was you don't really want to make 50 basis point moves. Moving 25 basis points, kind of marching along at that level, there's a reason for it. Beyond just worrying about what investors think, it's because banks need that time to make sure that things don't go haywire in the loans that they're writing, too.
Yeah.
If you have lockstep 25 basis points, if you think things are maybe 100 to 125 basis points too tight, you don't cut that overnight. You go gradually.
Right. But it's not
especially when it's not an emergency.
Yeah, but it's not really unprecedented even for the Fed to start with 50. They did that in 2007, and we didn't even really get the big pullback in GDP growth until 2008. They started with an emergency 50 in January of 2001. The unemployment rate was actually even lower than it is now.
But I will say, in both of those situations, you were talking about much bigger problems on the horizon, 2001 and 2007. 2007, anybody in the industry knew that there was some serious stuff on the line.
Yeah.
Things roiling in the back markets that could take lots of other things down.
Yeah.
2001, again, you're talking about very different situations than what we're dealing with today.
Right. I would just look at the labor market data, and I don't think anyone should conclude that we're not headed towards a weaker labor market based on what we've seen in hiring trends and the increase in the unemployment rate. Again, if you're waiting to see layoffs, you're already too late at that point. And I think, 25 a meeting, you're getting to neutral well over a year from now. I don't think that's fast enough for Fed officials.
Okay. Again, it wouldn't surprise you if you saw either today?
No, of course. It shouldn't surprise anyone, I don't think. This is a pretty abnormal meeting where we really don't know what the outcome is going to be. That's very abnormal for the Fed.
You were calling this very early. What weakness did you see in the labor market at that point?
Yeah, it really was things like the hiring rate pulling back. So we were seeing that really end of last year even. The hiring rate is at 10-year lows now. You see that in survey data also, more part-time employment, more, a decline in hours worked. All those look like easy ways that employers are trying to cut labor costs. And you're doing it those easy ways first. But the longer that you're trying to cut labor costs by not hiring, and you're still trying to cut labor costs, you're just getting closer to that step of, more extreme labor costs.
You're one of the people that got the market way out in front of itself originally, where people got mad. Why is the market? And it totally flipped, and it got down to maybe we'd get one. So for a while, you were like, wow, we caused the market to get way too bullish on rate cuts.
I don't know if we caused it.
You didn't cause it, but do you remember when people were yelling about how the market should have never gotten ahead of itself? Why is the market seeing all these rates? So for a while, you must have been questioning whether that was a.
Oh yeah.
There were a couple months.
Oh yeah,
there.
Absolutely.
Then it came all the way back around.
Yeah.
To where
yeah.
now we're having you on saying she did this and did. For a while you must have, but you were.
It was uncomfortable.
Was
yeah.
it? But you were steadfast the entire time.
Yeah, I mean, as economists, we have the luxury of not having to trade this.
As economists, we have the luxury of never having to be right.
No, we want to be right. That's of course the goal.
Right.
But we have the luxury of being able to look at the data and historical trends and patterns, and not get too bogged down in maybe 1 month or 2 months of data, but look at the trend over many months and many different data sets. And to that, that's what it looked like to us, that this is a labor market that looks like it does before recession.